please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, yeah, makes for great TV, and of course we'll have more coverage through the day on that. But we have a market to deal with, and a market that's struggling around the 10,800 mark on a closing basis. This is Morning Call. I am Anuj, with me Sonia and Surabhi. Good morning, both of you.
Hi Anuj, good morning.
Good morning, Sonia.
Hi, good morning. You know, we saw that handshake, right? We were discussing it. But something interesting that I read on the internet, apparently Kim Jong-un has taken his own toilet seat and gone for this summit because he doesn't want the intelligence agencies to figure out anything about his health. So don't be fooled by that handshake. There could be a lot of volatility in that meeting itself. But Anuj, anyway, you know, I wasn't there yesterday, but I did see by the end of the day nothing much happened except that the Nifty did struggle at the 10,800 mark. And I noticed that a lot of the banks, the private sector banks, have now started to fall. I don't know if that's a worrying trend about whether this market will start to struggle at the top. But when some of these key, sectors that have a lot of strength, they start to fall, then would you be worried about which way things are headed? You know,
Sonia, the issue here is private banks, and in particular stocks like HDFC Bank, in the past have rallied so much, and now there's so much FI selling, and so obviously, where would FI sell? Normally these stocks. The point I've been making for some time now, if you see Indian market this year, and if you see the MSCI Asia ex Japan, it's up about 2%, and India is down 5%. Large part of that is because of our currency. Okay, but at the end of the day, it's a problem for the market, especially for foreign investors, and that in part explains the large FI selling that you have seen. For our market, it's been okay because for last 2 years we have seen FI selling, and it hasn't mattered. So the key is, does this domestic buying continue? But the point we made yesterday, or you were not there, I was telling this to Surabhi, 10,820 on closing basis was important because you've gone there twice and have come back. Once again, you rejected that. Now, it may not mean much. What it essentially means is that we are still in a range. What you had yesterday was a false breakout, and this market needs some trigger. I think the trigger could be if crude prices go back below 75. If something happens in this, North Korea and US meet, perhaps market gets a bit of a trigger. This market is trapping traders. In the first half yesterday, it trapped the shorts. In the second half, it trapped longs. Perhaps today it does the reverse. It traps the longs in the first half, then it traps the shorts in the second half. Essentially respect the market at higher.
Basically, a painful range is what we're going to have to trade with.
Exactly. You'll have to pay. This is not 2017. This is not a market where you're getting follow through of any kind on the long side or on the short side. So just you have to respect levels. The levels that I'm watching out for on the upside, of course, yesterday's high of 10,850. On the downside, 20 DMA of 10,650. I think it's a broad 200-point range now. As of now, the market is telling you that it does not have trigger to break past 10,850, but it does not have triggers to collapse below 10,650. Within that, you have to play your individual stocks and perhaps see if you are getting enough alpha over there.
Well, morning, Anuj. You mentioned oil, so we're just looking at some of the cues as well. So right now, all the global markets are treading water. I mean, there's absolutely nothing that's really moving on the screens, whether it's equities, whether it's bonds. The rupee is something that we perhaps should watch out for very carefully once again today, because the dollar is strong internationally. Also, perhaps pricing in this 25 basis points rate hike that one is anticipating on Wednesday from the Fed. So let's see how the rupee opens out today. And then, of course, you'll get a lot of commentary, by the way, from a conversation with the interim finance minister in just a bit as well. We'll talk about banks and what he has to say about stressed power assets. But, Anuj, just a follow-up point on the mid-cap market. And what that told you yesterday, because we had 2-3 decent sessions where mid-caps were showing some sign of life. But yesterday, the first hint of, perhaps nerves coming through in the market, and a lot of stocks were again on the red side.
Oh, yes. And, what was really interesting was yesterday's decline was actually happening in the quality names. Ashok Leyland, for example, was down. IGL was down, while the rally was happening in the names like PC Jeweler, Wakarangi, HFCL. So that made me a bit nervous. Look, it's possible to see some more short covering in mid-caps because they've been beaten down a lot, and there's been some genuine buying as well. Some bargain buying is definitely visible in a lot of names. You can't deny that. It's easy to dismiss everything as short covering. It's not. There's been a lot of buying as well, but once again, to make a point, this is not 2017. If you're buying mid-caps and small caps, you're buying it with the risk that they're vulnerable to fresh selling. I mean, if it happens or does not happen, it's anyone's guess. But a safety of large caps perhaps still is way to go compared to, buying mid-caps, because even quality mid-caps, like you saw with Ashok Leyland, in this market can correct quite easily.
Oh, absolutely. I was looking at the list of mid-caps that hit fresh highs yesterday. And once again, you know, all your consumption names, Marico, Avenue Supermarts, the VIP, all of those stocks are the ones that continue to hit new highs. But we have that big Trump-Kim Jong-un meet to track. Very interesting developments over there. But let's move on and tell you what else is lined up on the show. Let's take a look at what our wise expert has to say as we head into trade this morning. Indrajit Bhatia of Macquarie says mid-cap premiums over large caps have shrunk from 20% in October 2017 to 10% currently. He says there is still a large risk to earnings, but opportunities do emerge. He says domestic flows have held up at respectable levels and provide support to valuations, especially mid-caps. He highlights key mid-cap ideas in their coverage universe: Jubilant Foodworks, NCC, Prestige and Jubilant Life Sciences.
Okay, Neelkant Mishra of Credit Suisse says Indian equity market has underperformed world equities by 8% in 2018 so far, ranking 41 among the top 50 major markets in the dollar returns. He says it has lagged global equities every month but one. He had 6% of this is due to the rupee weakening against the dollar. He expects this trend to continue. He says while some USD weakness has relieved stress on the USD INR, the rupee is still among the weakest currencies globally. Neelkant adds that as the second derivative on GDP turns negative, stocks with domestic exposure may see negative surprises, which is quite interesting.
Oh, absolutely. What, 67.50 now on the dollar? I think that's how it closed yesterday. Yes, 67.41. Let's get you some views on how to approach the money markets. Remember, it's a one-week low that the rupee hit yesterday. Bhaskar Panda of HDFC Bank says Indian currency markets were quite range-bound, and depending on global events, volatility is expected to be low today as well. He expects the dollar-INR pair to trade in a range of 67.45 to 67.65 today.
Okay, and on bonds, Bhaskar says that recent GSEC auction was a success and Indian benchmark yield has been a bit subdued. He says that 10-year benchmark yield is expected to trade within a range of 7.95 to 8% today.
Okay, but of course, all the global and local headlines are being dominated by what's happening on Sentosa. Let's go across and take a look at the worldview with Mangalam.
Absolutely. While the headlines are being dominated by what's happening in Sentosa, I'll try not to talk about the historic Kim-Trump meet which is underway, because unless things go terribly awry, there is no real risk as far as the markets are concerned. If you take a look at the US markets, they closed in the green in yesterday's trading session, but those gains were limited on account of the trade war tensions. Remember developments over the weekend that took place in G7, and a strong indicator of the tensions were the currencies that we saw in both Canada and Mexico, where the Canadian dollar as well as the Mexican peso declined against the dollar. Big events lined up this week, right from tomorrow, day after, and on Friday. So we have the central bank meetings of the US, ECB as well as Bank of Japan lined up over the next 3 trading sessions. We'll watch out for that. Across the Atlantic, good gains coming by in the European markets. Most of that on account of relief coming in from Italy. Remember, that index has been fairly volatile. In yesterday's trading session, the Italian index gained about 3.5% after comments came in from the new finance minister, who has reaffirmed the country's commitment to the euro, and that led to a surge in financials across that era, the eurozone. If you keep an eye out on the cryptocurrencies, though, they're not doing too well. 8 to 10% cuts seen in Bitcoin, Ethereum as well as Ripple. But the Asian markets, they are slightly treading water ahead of this historic meet which is on. The Japanese index is the key outperformer there on account of the weakness in yen. Good news for the Japanese exporters, but the other markets, they are by and large in the green or perhaps in the red. If you take a look at the SGX Nifty, that indicates a mild red start as we open. No big moves on either side from the Asian indices. Okay, Mangalam, thanks a lot for that. Let's in fact continue with the global cues. Jeffrey Dennis, Head of Global Emerging Market Strategy at UBS, and Rana Gupta, Managing Director, Manulife Asset Management, Singapore, now join us on the phone line. Good morning. Jeffrey, to you first. How important is this Trump and Kim Jong-un's summit going to be, you think? And you think it has the potential to change things for the emerging markets in particular?
No, I don't think so. I don't think it's going to prove to be very important. Certainly in anything like the medium or the long term. I mean, clearly, if you were to get some sort of agreement whereby ultimately North Korea was willing to give up its nuclear weapons, which, if it were to happen, is a long way off. That would be very good, I think, for confidence, but that will be some way off. And I think we shouldn't probably build up our expectations too much about this first meeting. So no, I think that actually quite likely the central bank meetings are probably more important this week than the summit.
Yeah, okay. In fact, it's interesting because that's the view that a lot of experts have across the globe as well. So let's invite Rana Gupta on board too. Rana, do you agree? Because the market seems to be immunized to trade wars. I mean, even if there is a verbal spat, or a breakthrough in talks, a lot of people believe that it may not really impact global equity markets as much. Would you concur?
If the trade war were to happen, then of course there will be a big impact. But right now, the markets are not. That's not market's base case, because outcomes are, if it were to happen, is going to be quite bad. However, I think the market's expecting that cooler heads will prevail, and tariffs on things like autos is not going to happen. And already we have seen that in case of China and US particularly, that US had imposed ban on ZTE, but subsequently they reversed it with a fine. So market is hopeful that there will be progress and deals will be made and a full-blown trade war will not happen. That is a base case, but let us be clear, if trade war were to happen, that will have downside.
Okay. Jeffrey, I just want to talk to you about the central bank meetings that you mentioned. So I suppose the consensus is we'll see 25 basis points from the Fed. Is that already in the price? And what next for the U.S. equity market?
Yes, we think that's in the price. I think the most interesting thing will be, does the Fed formally go from 3 rate hikes this year to 4 rate hikes, which the dot plot has not yet got, at least what they've published so far. We think there's going to be 4 rate hikes taking the year as a whole, so we've had one already. But also, I think it'll be interesting to see what the outlook will be from the Fed for 2018. In other words, I think it's very much the long-term outlook, or if you like, the outlook for the full Fed cycle that will probably impact your markets from here. We wouldn't be surprised. I think the markets will be that surprised if the Fed went from 3 rate hikes this year to 4 rate hikes. A lot will also depend for the emerging markets on the bond market's reaction to anything the Fed does. But at the end of the day, if you've got a negative surprise in the Fed, they got aggressive, you could see some temporary selling in the U.S. But we as a house are pretty constructive about the U.S. market, and so any setback, I think, would probably be short-lived.
Okay. Jeffrey, a word on India in particular. It's been one of the worst markets this year. In fact, I was just looking at the stats, dollar terms. We've underperformed the MSCI Asia ex Japan's by a good 7%. And as Credit Suisse was also making a point, perhaps 41st rank in the 50 big emerging markets. What's bothering India in particular? And do you see this trend continuing?
We're neutral India. We're not underweight. We probably should be underweight. I think the soft trend will probably continue. I think the story is still an expensive market that investors are a little bit more skeptical about the growth story now. And I don't mean the growth story about the economy, of course, because that does look as if it's coming back as expected. But I think still disappointing earnings numbers. That's what we're continually saying as far as from our Indian strategy team. The earnings numbers are just not coming through as anticipated. And for that, with that backdrop, this market, frankly, just looks too expensive. And I think what's happening now is you're getting yet more, I think, foreigners beginning to take their money away from India, going elsewhere. And so, and you don't perhaps have the big flow into the market from domestics that you had in 2017. So there's nothing going wrong in India, I don't think. You've had the inflation pick up a little bit because of oil. But the market is just too expensive at this point for what is really not a very good earnings outlook. And I think we need some clarity on that and, of course, ultimately on the election next year as well.
Okay. Rana, what about you? I mean, foreign investors are rushing to exit India. At least that's the trend we've seen over the past 6 months. You think that could continue?
I think with the correction that we have seen and the underperformance that we have seen, the valuation, even if it were expensive, I think some of it has corrected already. And our view is that the factors where people are concerned about, whether it's fiscal deficit or current account deficit, should be well contained within 3.5% to 2.5% or thereabouts. Obviously, US dollar strength is a general worry for emerging markets, but we do think countries like India and indeed other Asian emerging markets is in a much better place as compared to 2013. And when we look at those kind of markets which are a better place, we would rather look at bottom-up opportunities rather than rank emerging markets based on the perceived macro strength, because it's all about earning on a sector and stock specific. But that said, we are mindful that central banks in India also have started tightening, and higher input prices and tighter financial conditions can have some growth on margin-related disappointment at sector and stock levels. That said, I think but even then, there are good medium to long-term growth opportunities available, and I think as things will settle down, foreign investors will keep focusing on those stories, and flows will come back.
Okay, gentlemen, thanks a lot for stopping by. So the sum and substance of this discussion is that apart from the histrionics that Kim Jong-un and Donald Trump are best known for, it's not going to have any major impact on global equity markets, this meeting that is. But here's a quick programming reminder. Our special series Hunting for Value will focus on one stock that has reported a strong fourth quarter earnings but is still languishing near its 52-week low. Is this stock a value pick or a trap, especially going into the 2019 election? Do stay tuned in to catch the stock and its value metrics at 9:50 only on CNBC TV18. Well, that, as you can see, is the early Asian trade. It's a mixed bag, but largely nothing much is happening, really. The big question, as we know, is will Kim Jong-un denuclearize in exchange for material benefits for his impoverished economy or not? But that's a question that we will get an answer to in a short while. For now, let's get our research team to tell us how to approach the trading day. We have a long list of stocks to talk about this morning. Anuj, what are you looking at today?
So two stocks on red side today, Sonia. One is Castrol. It's the weakest stock in the market. In fact, high delivery selling consistently. Just see the chart of Castrol. Personally, at one point I thought, it was a really decent value, but obviously something's changed here. And continuous delivery selling, close to 52-week low, perfect 20 DMA halt. So it's a stock that you should see decline at every levels, perhaps. The other is PNB. Again, on the red side, weakest stock in a weak sector. I know PSU banks are going through a bit of a short covering bounce, some buying as well. But yesterday, it ended 3.5% off the highest point and it ended at the lowest point. So if the first half is a bit soft, perhaps PSU banks could be underperforming today.
Actually, it's interesting you point out Castrol. Since the numbers came out, the volumes actually were just about 2% this time. And I don't know if you remember, we did the interview with the management where they said advertising costs are going to go up in the next few quarters. And at that time, you had indicated that, this stock could be on a weakening trajectory. And I guess that's what has happened.
Oh, yes. I mean, something has changed here. The demand for lubricant itself perhaps is on a way down, with the kind of new vehicles that's coming in.
Yeah.
But if you see the chart of the stock over a 6-month, 1 year, 2 year, it's in a bear market, clearly.
Okay, so those are some of the stocks on Anuj's radar. Let's move on. How can we not have a pharma in top 10? So we've got Ekta joining in. Ekta, there's a drug approval for Strides Shasun that's come through?
Well, yes, it is positive news for Strides. I expect the stock to see some amount of green today. They have received approval for Tamiflu generic, which is basically that flu drug. Remember that the market size shot up to over $700 million. So it is positive news for them. And but there is already a lot of competition in that space now. So largely, it would be a sentiment positive as opposed to a lucrative financial opportunity.
Oh, yes. Though keep in mind, it's really one of the worst performing stocks ever since its numbers. And look at that 1-month chart. It's really destroyed a lot of wealth. So generally, you've seen a bit of a sell and rally play out. It will be interesting to see if that also happens in today's trade. But look at the 6-month chart, the 1-month chart, 3-month chart. It's been very weak stock. But what's been strong is Mahindra & Mahindra, Sonia.
Yes, and the upgrades just don't stop. So we have another one coming in today, right? Goldman Sachs has raised their target price on M&M. It's now at 1,084 compared to 1,006 earlier. And they've also raised their earnings estimates. They say that there are 3 major launches lined up in FY19, and they will be launching in, in segments which are doing very well. So the compact SUVs, the MPV segment, which is roaring now, and they've gone ahead. Goldman Sachs has gone ahead and raised their FY19-20 revenue and EBITDA estimates by about 2 and 3%. So as they say, the strong get stronger. Maybe this could see an up move today.
Okay, so M&M definitely on the radar as well. Ekta, back to you. The wait for Fortis gets longer and longer. We don't even have results now, as per the earlier schedule.
Yes, well, it is definitely like history replaying itself from what happened in the Q2, Q3 numbers for Fortis. So they have delayed their board meet in terms of, declaring the numbers to the 25th of June now. That is because they need to incorporate the Luthra and Luthra report, which is now with the auditors as well as the Audit and Risk Management Committee, plus has been submitted to SEBI and SFIO. And the final bids, which were due on this Thursday, have now been delayed to the 28th of June. Obviously, the lack of any idea about what the report contains and the uncertainty will result in the stock being under pressure.
Okay, thanks a lot for that. There are some smaller stocks that will be in focus. Sonal is here to give us that list. Sonal, over to you.
Thanks a lot for that, Sonia. I'll start with DCM Shriram Limited. Well, the board will be meeting on 18 June to consider buyback option. As per board's approval, they can buy back around 760 crore rupees, and as per shareholders' approval, around 304 crore rupees. But cash on the books as on 31st March is around 148 crore rupees. But for today, expect some green on that stock. Usha Martin will also be in focus because the board has decided to explore the sale of its steel business in order to achieve the objective of deleveraging the company. Expect some green on that stock. Inox Wind has finally appointed auditors for next 5 years, independent auditor. Expect some green on that stock as well. Kridhan Infra will also be in focus today because one of the associate companies has won an order worth rupees 180 crore rupees. Expect some green on that stock. GMR Infra, the promoters have been buying shares from the open market, and again promoters have bought around 53 lakh shares from open markets in last 3 trading sessions. That stock will be in focus as well. Hotel Leela will be in focus because the board has approved issue of around 125 equity shares to JM Financial ARC, and also the board has approved an increase in the authorized share capital from 260 crore rupees to 460 crore rupees. Back to you.
Okay, thanks a lot for that. So in case you missed out on any, here is a quick recap of our top stocks expected to gain. Our Stride Shasan, DCM Shriram, Usha Martin, Inox Wind, Kridhan Infra, GMR Infra, M&M. While stocks that could be under pressure today, Castrol, PNB, Fortis and Hotel Leela.
All right. Now, beyond that list, we need to also watch out for banks. Among other things, there was a release by the Reserve Bank of India yesterday. Now, this is a move that the RBI is making to ensure certain amount of discipline within large borrowers and ensure that loans aren't perpetually rolled over. Ritu has the details of what the RBI's draft circular says.
In a move that is aimed to enhance credit discipline among large borrowers and also mitigate risks for banks that have exposures to such large borrowers, the Reserve Bank of India has now come out with draft guidelines on the loan system for delivery of bank credit. It starts by outlining that large borrowers will be defined as those with a credit exposure of 150 crores and above of working capital fund-based loans. What it says is now there will be a minimum level of loan component of 40%, which then becomes an on-balance sheet item for which banks will mandate have make standard loan provisioning. It says drawings of up to 40% of that total fund-based working capital loan will be allowed, and any excess of that can be allowed to be withdrawn in the form of cash credit. However, the unwithdrawn or the undrawn portion of cash credit or overdraft limits that have been sanctioned to such large borrowers will now attract a credit conversion factor of 20% with effect from April 2019. Now, CCF, or credit conversion factor, essentially converts an off-balance sheet exposure to a credit risk equivalent, thereby securing banks also against such defaulters and ensuring that large borrowers also, do not roll over loans permanently. In fact, Reserve Bank of India goes on to say that this 40% loan component will be increased to 60% by April 2019. The first 40% guideline will kick in from October of this year. Draft guidelines have been put on its website and comments have been invited by the end of June.
Okay, well, thanks, Ritu, for that. Let's take a quick break. But on the other side, we'll find out from our technical experts whether this 10,800 level can be conquered anytime soon. Stay tuned.